Hi, this is Randy Finney with the right side of the chart, and this is an early session update for Tuesday, June 17th, 2025. It is 10:24 a.m. Eastern Time as I'm starting the video, so we're almost an hour into the trading day. Figured I'd get one video out. We'll keep it relatively brief. We're going to just look at the quick overview of the equity markets, and then I want to focus on the two things that have a definite impact on the stock market, and that's Treasury bonds, i.e. interest rates, and crude oil. So we'll get to those. And I'll hit on the economic reports we had out today. But let's just do a quick overview on the charts. I'll just stick with QQQ here, starting out with the 60-minute chart, my favorite swing trading time frame. This is that bearish rising wedge it broke down. We have some pretty much momentum is really stalling out. This is a market that seems it doesn't want to go down, but it's not gone up in the last week or so here. You can see actually since late May right there, it's kind of in this trading range here. And the sell signals that I gave you last week are still very much intact. It's been up, down, back, forth. So let's jump out to the daily chart, show you that's what it looks like there. You've got the negative divergence like you do on the 60. So we have, it's what I call the charts are stacked, term I made up when you can go to all the time frames, the ones that, swing trading, shorter term time frames, i.e. the intraday charts like we just did, 60-minute daily. They're all singing the same song right now, overbought with negative divergences. And here's the weekly chart right here, QQQ. This is your primary uptrend line off the early 2023 lows. Breakdown right there, and a near back test of that primary uptrend line. Again, this primary uptrend line off the 2020 beginning of the 2023 lows. That was a pivot moment right there where we went full long. And my top picks were the Amazon, I think it was Amazon Apple with an overweight on the Mag 7. They had the rest of the stock market peaked back or bottomed. Troughed the S&P 500 back in October, but the Nasdaq was lagging, and that was a great opportunity. And so it's also defines this trend right here. That's really the end, if you will, for the Nasdaq of that previous bear market. And so this is the whatever you want to call it, bull trends. Let's not put labels. Bull trend, bear trend, and that's it. So we're right there. A near back test again, any marginal new high anytime soon, which would coincide with a back test of the trend line, is guaranteed. Again, if it happens soon to be a divergent high, we may or may not get that. As I've highlighted many times, when the market peaked back in 2021, the Nasdaq peaked back in, I think it was November, and looked like it was, new highs were a shoe in, just like they're talking about now. The S&P 500 barely eked out a new high in the beginning, right in the start of the year, January 2022, but the Nasdaq failed to do so. The Nasdaq 100 falling shy, and then that whole bear market came. So that's where we're at. And then the other thing I have here, you can see here, the PPO line, the zero line, which is the last of the two to cross. That's the 9 EMA on the PPO. It delineates bull and bear trends with when the signal line is above or below it, with the trend changes typically coming shortly after the bearish crossover during bull markets. Remember, this is all part of a larger bull market, and so you're going to get the better sell signals. The buy signal is going to come a little late after the bottom's in a bull market. That usually goes the other way once you establish a primary bearish trend. And so you can see right there, flipped. There's only been 1, 2, 3 instances in recent years. You can see as far back as I go, and again, that's why I use a white line. It did not cross here. So we have 1, 2, 3, now 4 instances in the last, what is that, a decade almost? Right here, no, over a decade. Yeah, wow, time flies. It's going back to the last bear market, 2009. So again, with a zero failure rate, these were all the biggest corrections and or bear markets. I didn't have that one boxed. There's the Great Recession right there, 55+% drop. And just want to say that sell signal is still intact. Again, it's the signal line right now is currently back testing the zero line. And that often acts as support and resistance of zero line. So we're at that, again, it's one of many trend indicators. Some are bullish right now, some are bearish. But I'm just going over the ones that I have that, that I've used for years and covered many times on this site. And then on the monthly chart, one of the most reliable trend indicators, as I've covered many times, is the PPO histogram, which is just basically the differential between the PPO line, the blue line, and the signal line, the 9 EMA. And when they cross down, that's called a bearish crossover. When the signal line, the PPO line crosses the signal line from above or below. And again, without exception, all of the big corrections, meaning high, the double-digit corrections, all of them, without fail, and bear markets were identified early on with the bearish PPO crossover. Hopefully you can see it. Again, I've covered it many times, and so that's still on a sell signal. So despite what seems like a market that just refuses to go down, we do have some long-term sell signals that recently triggered. And again, they may flip. And if they do, guess what? It already signaled when we got it, and I highlighted then, a 25% drop. The $1,000,000 question, is it going to be more? And again, when it flips back over, at that point, it's pretty safe to say that that was it, and maybe we're going to go on and have more than just a marginal new high. Once in a blue moon, you do get a whipsaw, but again, even then, COVID was a quick one and done there, 31% drop, 36 in the S&P, and even it had one single, little there, or two really. It was about two histogram clicks. So that's kind of the big picture. Let me get to the other stuff I wanted to cover here. There's really no change in the posture of the Nasdaq 100 in the last couple of days. XRT, the retail sector, as I've been highlighting, consumer spending accounts for over 2/3, about 70% of GDP. So the government, as bloated as they are, and as much as Trump is just like the previous administration, spend, swell up the deficit, don't worry about it, we'll worry about that later. The government cannot spend their way out of a recession. So all I can tell you, again, the XRT is retail sector ETF, but it kind of gives you a pulse of the consumer. Beautiful bearish rising wedge. Again, we hit T3, my third target. Out of 4 targets, T4 still down here, still favored. Nothing goes, when you have a primary trend, everything works in waves, smaller waves within the larger waves. And so that's still a likely target. And then a recent sell signal, very impulsive breakdown. And, we're still well below the wedge. And this is where we cover all shorts, go full long because of the many various reasons stated back then. Now, today we had retail sales. Again, you can access the economic calendar under resources on the right side of the chart.com, top menu of the site, and then go down to tools of the trade. You can see here retail sales missed by quite a bit. Consensus was a negative point for a drop. We've seen this consistent trend. Came in, instead of a drop of 0.6%, actually dropped almost a full percentage point, closer to the low end of the range right there, and well below consensus. X vehicles month over month also missed by a large margin. They were looking for a gain of 0.2% and negative 0.3%. And, this market continues to spin news as they want to. If you look at retail sales, there's a gazillion indicators. It has been a mixed bag on the hard indicators, but again, most of them clearly trending in the wrong direction. But the stock market wants to ignore that right now. And this is a historical chart, as you can see here, of retail sales right here. And the recessions, I don't have them. Let's see. I don't know if this one I pulled. Some of them will let you shade the recessions in gray. This one doesn't have it, but I can tell you where they were. We know where they were. The dot-com bubble right here. This is when the stock market peaked, March of 2000, and we had a recession that followed. Pretty good one. And you can see retail sales were down. We had a recession, as we all know, in the financial crisis, 2007 to 2009 bear market right there. And then we had, of course, COVID. Retail sales fell off a cliff. And here, you don't even have to squint to see the chart. Retail sales have clearly been trending lower. But again, it's something the market can choose to ignore bad news when it wants to. And that's just a trait of the market right now. It's got a strong bid. And what happens is, it's kind of like, I use the analogy. In fact, I got to go to a derm appointment next week. They just called me right now. I had a mole cut off my leg, and they said precancerous on first. And they got to go in and got to cut back, and now the biopsy came back negative, and they're going to go back in and do a deeper cut just to make sure they get everything clean margins. And my analogy I like to use is go ahead, ignore that mole on your skin that's changing colors and getting a ridge texture and all that. Ignore it at your own peril, because if that's melanoma, the longer you ignore it, the more likely, the more detrimental the effects are going to be. In other words, you get behind the curve on something like melanoma, then you're pretty much gone, or you're going to be fighting a very difficult battle. So easier to kind of heed the warnings when you see them, and that's what the market's doing, in my opinion, in a lot of cases, ignoring or shrugging off certain elements that are warning red flags. But again, I'm speaking fundamental, guys. At the beginning of the video, I just covered the charts. That's what I go off of. But this stuff does factor in, and I just, from time to time, air that out. So those of you that kind of look at my long-term targets and think I'm smoking something, off the silly tree or whatever it is, coming out with these 55%, 50% drops in the Nasdaq 100, know that very, very much so fundamentals factor into this, and we're going to get to that right now in another thing. Let me just go back to the economic report today. Where were we? Oh, right here. The other one we had was industrial production again, and we can look at all these. Consensus was for a gain of 0.1%, missed by quite a bit. The actual was a negative 0.2% drop month over month. And so same story. And, these things have been trending over. Nothing's been crashing. It's been a slow roll. In the narrative that I get, kind of the gist, the consensus is, the market is cheering for a little bit of bad news because they just so desperately want that Fed rate cut they've been clamoring for a long time. But now let's talk about that, and this will wrap the video up. I'll be gone this afternoon, all afternoon. I've got to take my son's flying out. He's doing a summer semester for college in Spain, and we live in paradise. But the only international airport that I know of that flies literally to two. Direct to two locales. You can either fly to Frankfurt, Germany, or you can fly to Toronto out of Southwest Florida International Airport. So anyway, I got to cross the state to go to Miami International as usual anytime we jump on a flight. So like I like to joke, we have the only international airport that flies to nowhere. Even our domestic flights, you got to fly through one of the hubs, Charlotte, Atlanta, or Houston, to go anywhere. All right, so the way I'll be gone, that's a 3-hour drive each way. So I'll be gone this afternoon. Just want to get this video out to you and let you know I won't be replying to anything today after lunchtime. Let's talk about the rates. We'll just use IEF. Well, let me start with TYX because I do think the 30-year is important. That's the one that's going to let loose first. If it's going to make a new high again within spitting distance. This is the yield of the 30-year bond. Again, we look at a weekly chart. This is a very long-term chart, and again, I'm doing this. I know I've been covering this on an almost daily basis. If you're new to the site, this is the yield of the 30-year right here. It's been pushing, threatening to break out, and if it does, I'm drawing a line. It's going to take us back. This is, again, a breakout's going to put you above that level, and it could take us back to where rates that weren't seen until the early 2000s, even into the 90s right there, right? That's pretty much, this is where we're at rates right now, or just kissed where the financial crisis started right here, 2007, the big drop into '08 right there. That's where rates were then. So this has a very significant impact, or should, from a fundamental perspective, due to higher rates. So we'll see if that happens or not. And then let me just take it home with these two charts. IEF is the 10-year Treasury bond ETF. It tracks the 10-year. And all the way back to the beginning of 2024, I started to create these zones, and they've worked very, very well in predicting helping aligning the correction. So what this is, it's using technicals, i.e. a chart, but from a fundamental perspective, because the high rates, the market, again, my notes, pretty much say it. Green is net bullish for the stock market. Yellow, the stock market starts to take note of rising yields. Orange zone, the stock market really, with an emphasis on really, starts to take note of rising yields. And the red zone, the stock market will freak out. If we've yet to get to the red zone, Again, something to watch, but we did just punched into the orange zone recently. I think you can see that here. If not, there it is. And here we are. So we're sitting precariously above my orange zone. And again, I've covered this many times in the past that without fail, we got in there. I highlighted it at the time. Again, these charts, I've been using this for a while. And the biggest corrections that we've had in years, very profitable to trade on the short side. Also very profitable to exit your longs, or you can tighten stops if you were bullish at the time or long position to sidestep those big drops. I'm saying that for those of you that might not like to short or want to short. And so just something to watch. We're not there yet, but we're within spitting distance. Just like the 30-year bond is in spitting distance. 30-year bond is kind of here. It's threatening those previous highs. It's right up relative, right about right here. Remember, the yield curve right now is positively sloped. That means longer term bonds are paying higher rates than the shorter term bonds. That's why the 10 years not at breaking out to do multi-year highs or threatening that right now. But again, it doesn't have to, because this is the zones I have identified and it's worked so well. There's that little caveat, a couple caveats there that mainly if it's any advance due to a strong stock market sell-off. In other words, if Treasuries start doing this because the market just drops hard and starts selling off, let's say something crazy escalates, further in the Middle East or something else. God, there's 101 shoes to drop, and this market is just being super complacent, which again is bullish that you have that strong bid beneath. But again, I just used that analogy earlier. Continue to ignore warning signs and risks at your own peril, whether it be in the stock market, finance. I've seen this movie time and time again. That's just how it is. That's how it was in March of 2000, when anything within Word.com and all the smart quote unquote people were warning it's a bubble, and the retail crowd just kept chasing the .com bubble. And it was followed by 80%, nearly. It was like 78, 80 when the measure you look at on the drop in the Nasdaq composite. The entire index dropped almost 80%. So the bigger the bubble, the harder they fall. All right, so that's it, guys. Watch that. We're very close. And then finally, I'm going to take it home with this one because I highlighted it the other day, and we're back there. USO. This is crude oil ETN, the first to market, the most liquid one we usually use. If I'm not trading futures, I'll share this as a trade idea on the site. It's been around for years. Does a good job of tracking crude, as good as any ETN or ETF can. Remember that futures are what these ETNs, commodity ETNs, use. They can't do a perfect job. If you want to track crude prices as closely as you can, then you need to trade futures. Otherwise, use these ETNs, ETFs. But they're easy to chart and to watch. So way back then, around the same time, all the way back in the beginning of 2024, I created these three zones. And, I created them based on the past action. So what I'm going to do is I'm going to go back. I haven't done this yet. I'm going to go back and show you. This is the orange zone. So just the other day, if you recall, I mentioned that we popped for the first time. We've had 1, 2, 3 and only 3 entries into my orange zone. As I covered the other day for you, each and every one without fail led to the biggest, were followed by the biggest drops of stock market. Remember, within a bull trend, there's been some very profitable corrections to trade. And those were all without fail. When you got in the orange zone, the corrections came. And so the other day we popped into it, given it was a one day, could have been a one hit wonder right there, but and we had a nice pullback the following day, but they bought crude back up and closed it right again at the base of the orange zone. And so I just wanted to highlight, we are there again today. I cannot put enough emphasis on this. This is important. If you want to know why, if you're new to this, again, it's just like Treasuries. It's a fundamental issue. Fundamental meaning how it's going to impact the economy. Crude has the biggest impact. Housing is the only other sector that carries a higher weight in the CPI, Consumer Price Index, but housing is such a lagged data. There's no real-time indicator. Crude, like I say, is the most reliable real-time indicator for inflation. Just about everything permeates. When crude goes up, it trickles down to almost all facets of the economy, from moving goods and service, moving goods, trains, planes, automobiles, getting supplies and products, finished goods and raw materials and everything else. The manufacturing process, plants don't run, on fairy dust. They run on electricity, which is, again, off the grid and energy to just everywhere. So when crude goes up, it has an impact. And in the environment we're in, the most hottest inflation since the 70s, so roughly half a century. We're just coming off the heels of that. The stock market is still hypersensitive to inflationary forces, and this is where your rallies come from when we abate. So let's just go through this real quick. What I have here is let's see if I can pull it up, if I did this right. Yep, there it is. So this is the same chart I just gave you up top. Just you have to bear with me. I had to scrunch it down to fit it in here. And these lines are going to show you. So right now we entered the orange zone. That's up top here. Let me just make sure you can see right here. We entered the orange zone. The previous time was right there. That happened, right? And I identified it at the time, and we got that. And that was one reason we were able to, one of several reasons we were able to short that down. Of course, there were other technicals into the charts, some sells, just like we have now. The divergences, then came sell signals with bearish engulfing candles, trendline breaks, all that good stuff, breaks out of trading ranges. The time before that was right here. Again, if I put the crosshairs, you can see the crosshairs lining up off just that up top. You can see they're matching the charts. So right there, and that's when we entered it right here. So that's really when you want to take notes. So, there's sometimes a little bit of a lag or sometimes not so much of a lag. Again, what I'm highlighting for you here are the biggest drops forget that down arrow. Then crude finally abated, and then you got a big rally. And so we're there now. The time before that was right here. We entered the orange zone right here. Boom. Again, are you seeing the pattern? Zero exceptions, zero variance, zero exclusions. That was the biggest drop up to that point for a long time. And then right back here, let me scroll back just a hair. Oops, there it is. Remember, the orange zone is right here. So this is where we entered it. We had persistently high crude prices. So you entered it right there. You got that initial shot, a little pullback in crude. You enter the orange zone again right here and there. So again, without exception. Can it be different this time? Sure, it can be different. But part of what I do all day long, day in, day out, is pattern recognition, looking at things that matter. Again, if this was just some random security that had nothing to do, and you couldn't, struggle as you may, you couldn't tie in a fundamental reason why that's bearish for the stock market, then you might say, you know what, I took the statistics in college, and that's your sampling part. You're only going back 4 or 5 years, and that could be attributed to randomness. Again, it's 100% zero miss. Like I said, we came close there, but we never got into the orange zone. Although we kissed the top of it right there, and there was still a good drop. So okay, I shouldn't go any further. I think you get the point that rising crude prices are inflationary. That further puts handcuffs on the Fed and Powell when this happens. And yes, is this rise happening from due to what's going on in the Middle East? Certainly is going to help the rise in crude prices, but crude was already shooting up like a rocket long before this happened. Whether little birdies, were landing on shoulders and telling those in the know what was going to happen, or just organic forces. We're in a persistent inflationary environment. The market has rallies when it sees these abatements of inflation, inflationary forces, primarily, again, crude oil. That's that. So I'm just going to leave it here and tell you the takeaway is just watch this, because it's not binary. Although I did just show you on the chart going back for years, it pretty much was once we crossed the threshold. But again, it's also incremental. In other words, the longer you stay up here, just like I had in my notes on the Treasury bonds, the longer yields stay elevated. Same thing with crude. The longer you stay in the orange zone, let's just say you went like this sideways, or the higher you go. Again, that's why the red zone is up even higher. And is it any coincidence right here? We punched into the red zone, and then that was on January 15th. What happened to the stock market on after January 15th? Let's turn off all the lines here. The one and only time we went into my red zone, again, that was created over a year ago. Right here, the market didn't immediately go down, but it immediately stopped going up. It didn't go, it stopped going up here. That's actually when we hit the orange zone. And so we were in this trading range, and as predicted, we'd get most likely a downside break, and also as predicted, whichever way this range broke would be the next tradable trend, and that's what we got. And again, if you think it's mere coincidence, it all factors in. There's a lot of things that go into this, but crude oil, I don't think anyone can argue that rising crude prices, especially in this hypersensitive environment, are a net headwind for the stock market. Now we'll see. Does the market ignore it for a couple weeks, punch on, make a marginal new high? Again, I can flip a coin right now. We're so close, it would almost be a surprise if we didn't get a marginal new high. In fact, I kind of wish we just get it and get it out of the way. But again, sometimes when everyone's expecting one thing, another thing happens. And we certainly saw that back here, that the market, everyone thought it was a shoe-in. The Nasdaq would punch out to new highs, but it failed just shy of the previous high. And then that came. So, all right, guys, that's it. Those are the things to watch. And again, it's not so much binary. It's more of a, incremental thing. The higher you go into the orange or into the red zone, or the longer you stay up here, the greater the impact. In other words, you can, the economy can absorb a brief punch up into there if crude prices fell right back down. Again, I can't say definitively. All I can tell you definitively is that is a net headwind. I'm sorry, tailwind for the market, meaning bullish for the stock market. That's a net headwind. But what happens is, see, once a correction starts, crude will start to fall. Why is that? It's demand destruction. So when the stock market starts going down, all the analysts come back out again and say, oh, well, yeah, we were wrong. Maybe the recession, the odds are higher. And so all of a sudden, crude traders will start pricing in what we call demand destruction, saying that if the economy is slowing down, then fewer people are going to be taking vacations and more people will be laid off, so less people going to work, less cars being built, so less energy pulled from the factories, et cetera, et cetera, et cetera. I think you guys get what demand destruction is. So that's why you get this little cycle here. Wash, rinse, repeat. All right, I'm going to stop it here. Like I said, I've got to get a little time, and then I've got to get on the road and shoot over to the other coast and back today. So if I don't get to any questions that you put to me before lunchtime, I'll do my best. Depends how late. I think I'll be getting back late tonight, but otherwise I'll get to you tomorrow. This has been Randy Finney with Right Side of the Chart. Have a great day.